As a fraud examiner, I look at this and see a massive expansion of your attack surface. Today, we are breaking down what these agentic wallet tools actually do, where the legitimate use cases are, and how scammers are going to exploit this hype cycle. Let's start with the market context. The strong jobs report pushed rate cut expectations further out, keeping us in this higher-for-longer regime. Volatility expanded to levels we haven't touched since the 2022 drawdown. In that kind of regime, any automated system trained on the last 2 years of data is operating outside its training distribution. At the same time, we're seeing a wave of AI-powered crypto products launch. Coinbase announced agentic wallets, which are essentially AI agents with permission to interact with on-chain applications on your behalf. Other platforms are rolling out trading bots, portfolio rebalancers, and automated yield strategies, all with AI branding. And critically, the infrastructure companies building the AI layer are showing structural weakness. OpenAI shutting down their mission alignment team means the group focused on keeping AI systems safe and trustworthy is gone. xAI losing senior engineers signals potential product maturity issues. Then layer in the security backdrop. Microsoft just disclosed that attackers are actively exploiting a zero-day vulnerability in widely used software. That matters because every new tool you connect to your wallet or exchange account expands your attack surface. The more complex the tool, the more places something can go wrong. So let's talk about what agentic wallets actually are and what they're designed to do. The core concept is an AI agent with limited permissions to interact with decentralized applications using your wallet. That could mean automatically rebalancing your portfolio across protocols, executing predefined trading strategies, or managing liquidity positions in DeFi. The potential benefits are real. If you are managing positions across multiple chains, manually tracking everything is tedious. An AI agent can monitor price feeds, gas costs, and liquidity depth, and execute moves faster than you can. For tax purposes, it can optimize which lots you sell to minimize liabilities. For risk management, it can enforce stop losses or take profits without you watching the screen. But here's the structural issue. Whoever builds that agent controls the code that sits between you and your funds. Even if the wallet itself is non-custodial and you hold the private keys, you're granting the AI permission to sign transactions on your behalf. That permission is defined in a smart contract. If that contract has a vulnerability, or if the AI's decision-making logic has a flaw, your assets are exposed. Coinbase versions likely runs on their infrastructure, which means you are trusting their security, their code audits, and their operational controls. Open source alternatives give you transparency, but you need to verify that code has actually been audited and that the community is actively maintaining it. Most people won't do that verification. Now, let's address the bigger problem with AI-driven trading systems, which is their reliance on historical data. Most of these tools are trained on past price action, volume patterns, and order book dynamics. They learn correlations, build predictive models, and execute based on those patterns. That works fine in stable regimes where the future looks like the past. But crypto doesn't stay stable. We get regulatory shocks, liquidity crises, and macro surprises that shift the entire risk environment. When that happens, models trained on historical data fail because they never seen these specific setup before. Historical data-driven AI struggles in unfamiliar market conditions. That's not a new insight for quant funds. Long-term capital management blew up in 1998 because their models didn't account for the Russian debt crisis. Volatility targeting funds got crushed in February 2018 when volume spiked faster than their models could react. Professional quant shops with PhDs and millions in infrastructure struggle with regime changes. Retail AI bots aren't magically better. And there's a behavioral finance angle here that's worth considering. Sometimes human plus AI is worse than either one alone. If you're using an AI tool to generate trade ideas and you don't understand the logic, you might execute trades you wouldn't have taken on your own. Or you might override the AI at exactly the wrong time because you are second-guessing it. That's not a workflow that improves decision-making. That's just adding noise. From a market structure perspective, think about what happens if a lot of traders are using similar AI models. They all react to the same signals at the same time, which amplifies moves and creates crowded trades. We've seen these in traditional markets with momentum strategies and risk parity funds. When everyone's spot is selling at once, liquidity disappears and drawdowns get worse. Now, let's talk about scams. Because as a certified fraud examiner, I can tell you that AI is about to become the highest converting market hook in crypto. We're already seeing it play out in a few different ways. First, guaranteed profit bots. These are platforms claiming their AI has cracked the market and deliver consistent returns with no risk. They'll ask for API keys to your exchange account or direct deposit into a wallet they control. What they're often doing is either front-running your trades, charging fees that eat all your returns, or just straight up stealing your funds. The AI branding is there to make it sound sophisticated and legitimate. Second, malicious smart contract disguised as AI trading strategies. You connect your wallet to what looks like an automated yield optimizer or arbitrage bot. The contract has permissions to move your tokens. Once you approve it, the contract drains your wallet. The AI narrative is just window dressing to get you to sign the transaction. Third, deepfake endorsements. We're seeing AI-generated videos of celebrities, crypto influencers, even exchange CEOs promoting scam projects. The tech has gotten good enough that unless you are looking closely, it's hard to tell it's fake. Someone sees what looks like a video of a trusted figure talking about an AI trading platform. They assume it's real, and they deposit funds. Fourth, social engineering with AI chatbots. Scammers are using AI to impersonate customer support, create fake KYC verification processes, or post at account recovery services. They'll reach out on Telegram or Discord, sound professional, and walk you through steps that result in handing over your seed phrase or login credentials. And the attack surface is expanding because of the security context we talked about earlier. Microsoft zero-day exploits, vulnerabilities in wallet software, and phishing attacks that leverage AI-generated content. Every additional tool you connect, every permission you grant, is another potential entry point. The DOJ just hit Paxful for $4 million over AML failures. That case shows how platforms that look operational can be running with weak compliance and security for years before enforcement catches up. If a platform is pushing AI tools hard without clear documentation on how they work, who audited the code, and what permissions they require, that's a red flag. So how do you actually use AI tools safely in this environment? Here's my risk mitigation framework. Start by separating experimentation from serious capital. If you want to test an AI trading bot, use a separate wallet with a small balance that you can afford to lose. Don't connect your main holdings to anything experimental. Second, verify the builder. If it's a regulated firm like Coinbase, check what regulatory oversight they actually have. If it's an open source project, look for third-party code audits from reputable security firms. Check the GitHub activity. See if there's an active community that's stress testing the tool. If you can't find evidence of serious security review, don't use it. Third, understand the permission model. What exactly are you granting the AI access to? Can it only read your portfolio, or can it execute transactions? Can it withdraw funds, or just reallocate within the wallet? The more limited the permissions, the lower the risk. If a tool is asking for full control over your wallet with no clear explanation of why it needs that access, walk away. Fourth, treat AI as a feature, not a strategy. Use it for tasks where automation adds value. Monitoring multiple chains, tracking gas costs, summarizing news, or backtesting trade ideas are all reasonable use cases. But keep the final decision-making under your control. If an AI bot is suggesting a trade, you should understand why it's making that call and whether it fits your overall strategy. And fifth, stay skeptical of performance claims. If someone's promoting an AI tool with back-tested results showing massive returns, ask yourself why they are selling access instead of just running the strategy themselves. Real alpha gets arbitraged anyway. If a strategy actually worked as well as the marketing claims, it wouldn't be available to retail traders for a monthly subscription fee. From a market structure perspective, I would rather use AI to improve my research process than to automate execution. That means using it to scan news, identify pattern setups, or flag unusual volume. But I'm still making the call on whether to enter the trade, where to set stops, and how to manage the position. That keeps me engaged with the structure of the market instead of outsourcing my decision-making to a black box. Here's the bottom line. AI tools can be useful if you understand what they do, who built them, and what risks are you taking by using them. But right now, we're in a hype cycle where the marketing is running ahead of the technology. Companies are slapping AI labels on products to drive adoption. Scammers are using AI branding to make their schemes sound more sophisticated. And the infrastructure companies building the AI layer are losing the teams that were supposed to keep these systems safe. So if you're going to experiment with AI crypto tools, do it with small capital. Verify the builder and keep control over the final execution. Don't let the hype convince you that AI has solved trading or that you can outsource your risk management to an algorithm. The market doesn't care how sophisticated your tools are. It cares whether you understand the structure, whether you've sized your positions appropriately, and whether you can adapt when conditions change. As we're watching Bitcoin chopped around 66,000 in this elevated volatility environment, that adaptability matters more than ever, because the regimes where AI models work well are the calm, trending periods. The regimes where they fail are the ones we're in right now. If this breakdown helped you think critically about AI tools before connecting your wallet, hit subscribe for weekly analysis on where fintech innovation meets market reality. Drop a comment with the AI tool you're most skeptical about. That may help more people. Stay analytical. Thank you.